Hey guys, welcome back to Data Driven Value, where we show you the tools and teach you the skills to help you take your financial freedom into your own hands. So today I want to talk about us as retail investors, some of the issues we run into, some of the most common problems, things to prioritize when you're coming up with your strategy, as well as looking at some interesting statistics as well as data to really show how the traditional way retail investors seem to invest, a lot of it is based on psychology, and that's what's going to end up burning you in the long run. Essentially, the markets are designed to mess with your head and get you out of position. So we'll touch on a bunch of different concepts here, but I'm going to get right into things. We're going to look at this study. It is quite a bit old, but all of this information is still completely relevant. People haven't changed. Psychology is still the same. So we do see new research. Success is limited until DIY investors break bad habits. So DIY investors, that's us as retail investors taking our kind of investments into our own hands. And yeah, so there's a big influx of retail investors now because of the accessibility of stock brokerage apps. So things like Wealthsimple, Robinhood, they've really made it a lot more accessible for people to get into investing themselves. We will touch on that in a minute here. So obviously we see this started around COVID timing. Obviously, lots of people out of work, lots of people looking for an alternative source of income, so a lot of people, again, getting into these different trading platforms and really trying to take the reins, invest for themselves. We see here Morgan Stanley estimates that retail investors accounted for roughly 10% of daily trading volumes on the Russell 3000, so peaking at 15% in September 2020. Again, a lot of COVID stimulus came out, that was kind of just given to everyone. So a lot of people took this money. Some people went and bought toys with it. Some people paid their bills, but a lot of people took the money that they were given by the government and they put it into the market. We did see asset values really skyrocket. That being said, it kind of created this bit of a bubble. I don't like to call it a bubble, but it did create this frothiness in the market. There was a lot of liquidity. There was a lot of influx of new traders. So it wasn't surprising when we did finally get that broad market correction of about 25% from the peak of the SPY. So that one really hurt a lot of retail investors, and that's where you're going to see those retail investors who kind of came in during the mania phase, during kind of times where lots of other people were getting in, following the herd, buying high, and then ultimately having to ride that downtrend. And lots of the times they're selling at a loss. So we'll keep scrolling down here. Obviously, we do see that DIY investing shows little signs of slowing. Obviously, with the way inflation is and the cost of living, a traditional savings account or a traditional investment account in terms of bonds at an investment advisor. So that's kind of the thing, is it's not really outperforming inflation on the macro scale. You really want to be outperforming inflation. Otherwise, your money's essentially just kind of bleeding away in the bank account. That's essentially what got me into investing in the first place. I had a substantial amount of money saved up from a number of years of work, and then I just kind of had it in a savings account, not doing much, earning 3%, 4%, 5% here and there. It was good, it was nice, safe returns. But that being said, just adopting a bit of a strategy here, something I'm going to show you and something I have touched on before. I would have been able to kind of really put that money to work and really benefited a lot more from that, been in a more advantageous position than I am today. That being said, we all learn at our own pace. We all come into markets at different times. Don't let the timing kind of deter you. Don't think that it's too late, that you've missed your chance to learn or to start investing. Even if you're just putting aside a little bit of money at a time, a little bit per week into markets, you can afford to kind of put in there and leave for the long term. It's really going to benefit you in the long term. So again, I've shown you kind of the DCA strategies, and we'll touch on that later, but really showing you, you can compound amazing returns over a long period of time without taking on excessive risk. So we're going to talk about kind of some of the ways that retail investors trap themselves in these riskier positions, as well as kind of how to avoid it. And then I will get into those statistics, look at the data, and then give you guys a good idea of how I like to approach these markets again. Obviously, as people continue to turn to trading apps and online platforms to try their hand at investing, the question remains, can people make money? So I know investing is tough for sure. That being said, every strategy is different. You can mitigate a lot of the risk, and then just adopting a consistent strategy over a long period of time can really benefit you. I will show you kind of later on why that works out. But obviously here, it's widely accepted across the investment fraternity, just a way to kind of refer to the broad investing market market there, the majority of retail traders do lose money. So again, don't consider yourself a trader unless you actually trade on a short period of time. Think of yourself as an investor. You know, we're not here to get in and out of positions, making a couple percent here and there. Essentially, we just want to position ourselves at the bottom of uptrends, and we want to make sure that we're exiting our positions kind of when those trends start to change and look like they might reverse to the other side. That being said, the majority of our investments, we want to focus on what we believe in long term, what we think is going to be successful long term, and then again, just adopting that consistent strategy over a long period of time, following through, removing that emotion, and not getting burnt by the psychology that really burns a lot of traders. So yeah, again, more than 70% will have lost money with the benefit of hindsight. So that's why I like the charts. You can go back and really kind of back test your theories, look at the ways that price action reacts off different levels. I've talked a lot about this in my technical analysis guide video, you know, that is available for you as well as a written document in the description there. But obviously hindsight's 20/20, but we can use hindsight to kind of learn from our mistakes. Obviously a lot of mistakes can be avoided providing you know where to look. And again, it begins with psychology. So in 18 months from July 2021, basically more than 70% of the trades executed on Capital.com were closed within 24 hours. Nearly half were closed within 60 minutes. And then losing positions were closed 1.4 times more often within 5 minutes than winning ones. So this tells you essentially retail traders are opening positions, they're second guessing themselves, and they're closing those positions within a day of opening it. So you're not investing by the day, you're investing on a multi-year time frame. So it doesn't make sense, like what changed in that 24 hours that kind of negated your investment thesis? Or in the case where you closed within 60 minutes, what changed within that 60 minutes? You know, chances are nothing happened, but you know what does happen? Sometimes you open a trade and the market pushes that trade into a loss. You know, the market can stay irrational longer than you can stay solvent. That's why we focus on kind of lower risk assets for the majority of our portfolio. We adopt a DCA strategy so we're not taking excessive risk. And then again, we understand that we may go into a bit of a loss initially, but we're not going to let that affect the emotion or the strategy of our trade. The whole thesis of the trade, you've come up with that beforehand, you have your entry, you have your exit, and you have an invalidation point where you might cut that trade. That being said, if you're investing in something like the SPY over a long period of time, you might not necessarily use a stop loss because maybe you just want to accumulate that asset, you know, just keep building on that position, and then by the time, you know, you're getting to retirement age, you're going to have a pretty nice position there in the stock market. Generally, stock markets trend up and to the right. They do have periods kind of, again, where there's scares, recessionary periods. We do see 25 to 50% corrections in the stock market. You know, it doesn't happen all the time. It's only happened about 4 times in the last 25 years. I'll get into that as well. But obviously, hanging on to losing trades for too long and exiting successful positions quickly to lock in profit is often symptomatic of disposition bias. So essentially, this affects novice traders. And what it causes you to do, essentially, you go into a trade. Maybe it wasn't the smartest position. You don't really believe in the asset long term, but you're unwilling to close that trade because it's in a loss. So what I'm going to show you here, sometimes when you are in a loss, depending on that position, if you don't believe in it long term or you're worried of a long systemic downtrend, it can make more sense to sometimes cut that position. So I'll just show you over here. This is the drawdown trap. So I've talked about this in a different video as well. So essentially, you know, when you go down a certain percentage, you actually need to go up more to get back to break even. I know it sounds a little confusing. Obviously, you know, some people might think, oh, I've dropped 50%, you know, I'm down 50% of my investment. I just need to get that 50% back. But to actually get back to that same original place that you were at, you're down 50%. That asset needs to double from the current price just to get back to break even. So you see, as you kind of come down the ladder here, you just need you have to have more and more upside as your investment is bleeding. So lots of the times you will use a stop loss to protect yourself from really bleeding down to these lower levels. You can see here, if you went down 80%, you're going to need a 400% move from that price just to get back to where you were. So you can see here, a lot of the times it doesn't make sense to hold losers all the way down to a -80, -90%, because again, that's going to require a massive move just to get you to break even. So again, we can use stop losses to kind of mitigate some of that risk. Obviously, another one is exiting successful positions too quickly. So again, same as the opposite, you enter a position and it goes up, you're thinking, I'm a genius, I've made money, I'm going to take my profits off the table. That being said, you've just kind of sacrificed your long-term strategy to realize a short-term gain of maybe it's a small amount too. So again, it's not going to move that much in a short period of time. So you're kind of exiting that position, although you do have profits. That being said, you've just compromised your long-term position, as well as kind of just went against your whole strategy there. So obviously, either hanging on to losing trades too long or exiting successful positions too early, both can be very common mistakes made by retail investors. Disposition bias also causes investors to sell assets that have increased in value while holding assets that have dropped in value. So that's exactly what we just talked about, retreating from the original trading strategy, leading to risk management mistakes and larger unexpected losses. Obviously, there is a chronic fear of losing money. I suffered with this problem myself for the longest time. I was always raised to be very frugal, very smart with my money. I was never into gambling. I hate gambling. I hate going to the casino. I don't do any of that. I've never even bought lottery tickets. I'm just not a gambler at heart. That being said, so when you think of an investment market, sometimes it does feel like a gamble. You are betting on kind of certain companies or the direction of the markets, but it can be an educated gamble. Or I don't like to call it a gamble, but it can be an educated strategy there to really help remove some of that risk, some of those fears. You have to be willing to kind of weather the downside to be able to realize the upside. If you get into a trade and it just goes up and you nailed it and you were just 100% correct, that's awesome, but that's not always going to happen. And there are going to be times where you go down into the red first, but again, managing those emotions, not exiting those trades right away, only for it to kind of reverse and then wish that you had kept that trade. It might cause you to actually buy back in at a higher price. Not what we want to do. Obviously, people want to avoid facing the psychological impact of their loss. A lot of people assume I haven't lost if I haven't sold. That being said, we talked about that drawdown trap. So if you get caught in the wrong assets that you don't have actual conviction in, it's going to be hard to get out of those. And then again, you might end up riding that down way too far. Sometimes some of these assets never recover, and that would be a horrible kind of position to be in. I would rather take a 50% loss in something I didn't believe in whatsoever if I believe that asset was going to continue trending down, rather than holding something I don't believe in just for the sake of trying to get my money back out of that. You're gonna make mistakes. You're gonna be wrong here and there. The important thing is that we're right more than we're wrong, and when we are right, we're far more correct than we are wrong. So again, that kind of comes into the risk management, making sure that you're taking good trades where the upside really outweighs kind of the potential downside, and then again, protecting those positions either with stop losses or just DCA strategies to lower your cost basis. It's another way. Obviously here, most DIY investors fail to stick to their stop losses. I argue that most retail investors don't use stop losses. So a stop loss can really help you kind of avoid getting caught on the backside of a downward move. So let's say you enter on support and then the market starts going up, you're in profit. So what you want to do is make sure that you've kind of secured or protected that profit in a sense. You can use a stop loss. So if the market is to reverse, drop to that price, it's going to sell your position before you experience that sustained downward price action. It does help mitigate the extent of psychological factors around DIY investing. That being said, again, these limit orders, It doesn't cause, like, you're not going to go in and make that choice. You have the stop loss set, and it's either going to execute if the market drops, or it's just going to stay there, and then the market's going to keep trending up. And then again, as the market keeps trending up, what you can do is move your stop losses up continuously with the market, and then as the market keeps trending up, essentially you're securing more and more profit, you know, just by bumping those stop losses up. A really important tool. I do recommend you trying to utilize them if you can. Obviously, many DIY investors still don't use stop losses. And when they do, essentially lots of the times they move their limits. So that's kind of what people will put a stop loss on. My initial stop loss, sorry, excuse me. If I put my initial stop loss on, that is my stop loss until I reach my first target. So I reach my first target, then I can put my stop loss up at my entry price, and then again, that protects that position. But that being said, I'm not going to open a trade and then instantly adjust my stop loss higher, because that's where you might get a volatile wick in the market, getting wicked out of your position. You realize that loss, and then the market goes the way that you had initially thought it would, but it's left you behind because you're stopped out. So one way to kind of avoid that is placing your stop losses under good technical support. It's going to help you avoid getting wicked out. Also, we see here 60% of Capital.com traders globally were not using stop loss strategies. And then of those, only 44% were making a profit, and 49% of them adjusted the value before the original stop price was triggered. So again, shows you almost half of people will set a stop loss and then they'll question themselves and change it. So what we want to do is come up with our system, our strategy. Don't let the psychological barriers, the emotions really affect our strategy. You know, just let it play out. Trust yourself, and yeah, have faith in yourself. Have faith in your strategy, and then again, just follow through with it. Be consistent. Obviously, we see here a lot of it revolves around ego, so not being willing to admit that you are wrong. You know, you're gonna be wrong in this market, and it does pay to actually recognize when you're wrong. You can learn from when you're wrong, learn what kind of happened, where did that strategy go kind of awry, and then adjust that for a future setup. So obviously, this is an investor's nemesis, ego. The problem occurs when the ego gets in the way of an investing strategy. If it causes you to overvalue your own ideas, abilities, and knowledge about what the market should do. So while there is a lot of tools that we can use to kind of give us a cue of what's going to happen in the markets, that being said, there's a lot of things we can't predict. Getting kind of overconfident in your own personal ideas, abilities, and knowledge, that can bite you in the butt in the end. You know, as I said, the market can stay irrational longer than you can stay solvent. So really, again, we want to come up with that strategy that removes all that emotion, all the psychology behind it, and then again, just focusing on a risk-adjusted strategy that's backed by data. So obviously, again, one of the biggest obstacles remains breaking down those psychological barriers. We'll flip over here. So just looking at here, there's a good way to kind of structure your portfolio. I've showed this in a different video, but obviously, so risk management is going to be a big thing. You know, you don't want to take on too much risk, and so to do that, you need to structure your portfolio. Every portfolio is going to be slightly different depending on your risk tolerance. Some people like a mix of stocks and bonds. I personally like a kind of stock heavy, or an SPY or stock heavy portfolio, with some exposure to risk assets, some exposure to safe haven assets like real estate, and different kind of like bonds, high interest savings accounts, that kind of things. Things that you do that, you know, you don't risk kind of major downward price action in these. So it could be like gold, could be real estate, depends on your own portfolio. Having a cash position, that's so that you're able to buy the dip. Obviously, when we're entering these markets and you see a substantial retracement, you want to take advantage of those. I'll show you over here. Essentially, one of the biggest mistakes people make, again, talking about the emotion of traders, selling a losing position. So obviously, look at this. I've showed you kind of the stock market dating back to the 1990s. We see right here, this is the dot-com bubble, and we saw it peak, and then from the peak, it dropped 50%. So I've heard a lot of people, I've talked to a lot of people, I know a lot of people kind of around my parents' age that they were in they're in a bunch of tech stocks here, went up, it crashed 50%. You know, a lot of people got scared down here thinking, oh, it's going to go to zero. They cut their losses, and look what happened, guys. We reversed back to the upside, and again, climbing that kind of, that chart here. And then we come to 2007, 2008, the housing market crash, great financial crisis. And again, we come up here, people kind of again capitulating on this big downward price action here. So you hear it all the time, people saying their biggest regret, oh, I sold in the dot-com bubble, I sold in the housing crisis, or even here, maybe they sold in the COVID scare here. So this was a pretty crazy wick in the markets. Obviously, you can see these downtrends played out over a number of months, if not years, where this was about 3 months of kind of just 3 months straight down 36%. So obviously, again, people sold during the COVID dip as well, and look what happened. Those guys are regretting that. So obviously, don't if you believe in the asset. So that's why I like the SPY, because it does kind of trend up with time. So it's a good asset to really adopt a DCA strategy, buying into it over a long period of time, and then you'll see if you get these substantial retracements. So even here, like throughout the kind of stock market, we've only had 4 retracements of about kind of 30 to 57%. So again, maybe we get if we got a 25% correction from the current highs, that would bring us right down to this upsloping trend line in this parallel channel. It might be a decent place to buy the SPY. And again, 50% is going to be more of that kind of actual materialized recessionary potential down there. So really pay attention. It does kind of, it doesn't doesn't hurt to be DCing into the SPY. Sorry, but definitely remember that there is that potential in the event of a broad market breakdown to revisit lower targets as we have done in the past. But you see, these essentially offer generational buying opportunities. So if we do see 25 to 50% correction in the SPY, I'm going to be looking at buying that as aggressively as I kind of can. So definitely don't buy high and sell low. That's obviously what a lot of people kind of did. It's really hard with the emotion, but again, what you want to do when things drop down here and it's something like the SPY that you believe in long term, you want to be buying down here, not selling. So that's what we talk about. DCA, lower your cost basis, ride the trend back up, and again, just take advantage of those opportunities as they come. The markets do generally trend up with time, so a good thing to keep in mind. So flipping back, obviously, you're valuing your current overall portfolio. You have a mix of different investments. It is up to you kind of at the end of the day. And then I also like to structure my individual portfolios. So when I get into like Bitcoin and crypto, I also break that down in a similar fashion to how I break down my overall portfolio as well. So you can really see just coming up with that strategy with the allocations, that just stops me from putting too much into one asset, because then I've abandoned my strategy. So I try to maintain, certain percentages. Obviously, as you're taking profits from different positions, you might end up with more cash, in which case you take your cash position and you redeploy it on the dips into your heavy conviction assets. So again, we'll just look a little bit at dollar cost averaging. I talked about this before, but I just want to again emphasize the strength of a dollar cost average strategy. So this is the SPY. Again, if you just put $100 in per week from when I started investing, so around 2017 to right now, I would have put in 36,800. My current portfolio value would be 63,351, a gain of 26,550, and for a percentage, it would be a 72% gain across, about 8 years of investing. So really pretty good, just shy of 10% on an annualized return. So basically the running inflation rate for the year, or on average per year, is about 4%. So if you're making 9%, you're far exceeding inflation, as well as a traditional savings account. And again, I've shown you this one. This is Bitcoin. So obviously Bitcoin a lot more volatile. Again, this is if I put $20 a week. So this is what I talk about, risk adjusted positions. You might not necessarily weight Bitcoin as much as you weight the SPY, because the SPY is a much less volatile, much safer asset. Bitcoin, it's volatile, it's kind of scary, things move crazy. But I really want to show you the strength here. So again, if we look at putting $20 per week, so $20, that's nothing. Maybe you just, you don't get coffee at the coffee shop, a couple days a week, and you put that $20 into Bitcoin. If you did that every week, from when I started investing to now, I would have invested $8,480 in Bitcoin, and it would be worth $104,000 today. So that's insane. That's 1,135% returns on the asset. and all you had to do was put aside $20 a week. So really not that much to have a major effect in the long term. So really don't fade kind of the compound strength of a good DCA strategy. That being said, when I do talk about DCAing, I also like to do a strategic kind of DCA as well. So again, when I talk about this, obviously, maybe you're investing $100 every week all the way up here, $100 a week, $100 a week. When we get this drop, that's where you're putting in your 20% cash position. So this cash position, that's saved for substantial dips. That is not your DCA cash position. So make sure that you separate the two. And again, you're DCAing all the way up. You see the trend change here, so maybe you stop DCAing. You could stop DCAing here too. That being said, if your strategy is just to DCA weekly, you might as well keep consistent. Nobody knows where the bottom's going to end up. But if you see a substantial retracement like this, that's when you're going to really start to look to actually buy more amounts of the SPY. You're going to increase the amount you're buying into. So you might be buying $100 a week. You get a big drop like this, and that's when you're going to try and put in more money. So you start buying, either you can increase your weekly amount, or you can just start buying kind of lump sum amounts in addition to your DCA strategy. Same thing here, taking advantage of this substantial dip. Same thing here, substantial dip, take advantage of it. Same thing here, guys. Like, if you took advantage of all these dips, you'd be sitting really pretty right now in your SPY position. So don't fade kind of the ability or the real strength of both DCAing as well as buying the dip. That being said, you don't want to get caught in that buy the dip mentality at the wrong time. So that's when I talk about trends. If we're in a sustained downtrend that doesn't look like it's slowing anytime soon, you're not going to be consistently buying the dip. Essentially, that's where you want to use technical analysis to really chart those levels and then make those buys at the key levels rather than relying kind of, you just want to keep buying the dip. If you get dipped out up here, you still have to ride this all the way down. So again, this has happened to me, and that's why I say it. So that's kind of why I feel like, mistakes I've made personally, I want to stop you from making the same mistakes. You still might make those mistakes, but that being said, you kind of know in the back of your mind, I'm not supposed to do that. I don't want to do that. So obviously, coming up here, we saw this big pump up on this cycle here, right up to there, did really well, traded it quite well. I did make, it was about 5 to 6 times return on, it was mostly in Hive at this time and other miners. So kind of just going up here, timed it very well in terms of a peak. I didn't quite obviously nail the peak, but that being said, what I did was reinvested too early. So when we came down, sorry about that, when we came back down to here, this is when I thought, that's a really good time to buy, because obviously price was just up here. It's got to keep going up. But that being said, this wasn't the right thing to do because it wasn't proper market structure. This was actually a downtrend. If I had properly known technical analysis at the time, I could have recognized this trend and waited for the trend to reverse, getting in at a much better cost basis rather than buying all the way down through this dip. The same thing kind of even happens, like even in this cycle, if you were to ride up, let's say you sold up here, or you bought down here, and then you sold, or you rebought here, and then you sold here. But maybe you just think, it's going to keep going up. The market only goes up, and then you've sold here and you start buying back in because you think you're going to get that second leg up. So again, ultimately just bleeding, coming back to these lows. If you've kind of sold or bought as much as you can up here, you don't have any money left to buy when things are really cheap. So again, I just argue that having that DCA strategy and waiting for things to be at really cheap, strong technical levels, that's going to be the best combination to really maximize your potential in the long term. And again, we don't want to dip ourselves out too soon. So it's great to buy the dip, but make sure that you have some strategy behind it, based on technical factors. Make sure that the price action kind of supports your thesis as well. You definitely don't want to be, fully deployed back into the market rate here, only to have that bleed down another 60% or whatever. And again, Similar to up here, this is the same goes on the flip side. In times of euphoria, it can be it's hard with the herd mentality. Everybody says things are just going to keep going up and up and up. You want things to go up. They're maybe close to your targets, not quite there. I've talked about that before. Holding on to too much of your position here, that can be a negative thing as well. You end up kind of again down in riding through these downtrends. So we use that price action structure to really tell us what the potential trend is, and then it allows us to kind of cut our positions before we end up in a sustained downtrend where we need to really hit kind of a multiple X just to get back to where we were. So again, kind of what I saw here, we're coming up, I saw this resistance, this trend line coming from peak to peak all the way to our current cycle peak. So although I did have a technical target higher for the Bitcoin bull market top, I have recognized some external risks in macro conditions. And that being said, we went to 109,000, and that's within 10% of my target. So if you're buying between 15 and 20,000 and you go up 5 to 7 times your amount, and your target's 10% higher, and you don't sell and you end up being wrong and caught on the downside move, that's going to really hurt at the end of the day. You're going to be kicking yourself, wishing you had sold, wishing you took profits. So again, we talk about taking profits, securing them, but not fully exiting your positions in case of another leg up, but utilizing stop losses again to protect those positions. But again, it just shows you, don't always follow the herd. Don't always listen to the people who tell you things are only going to go up. You really have to listen to both ends of the spectrum when it comes to narratives. So you got to listen to the bullish people and you got to listen to the bearish people. You got to pay attention to the data, and then you come up with your own opinion and your own strategy. So really, again, it's all just about mitigating that emotion, that psychology, and focusing on your strategy, focusing on the data, and then again, just position yourself. And you'll know what to do kind of when the time comes, because you'll be reading the chart and it's going to tell you what's most likely going to happen next. So again, just a recap of common mistakes made by retail investors. Expecting unrealistic returns. So again, if you're entering Bitcoin right now and you're expecting a 5x kind of thing to the top of the cycle, that's going to be very unrealistic. I don't see any scenario of Bitcoin going to $500,000 this cycle. Obviously, the low was at 15,600. We're up 7 times from the low to the current high. That's a really big move. And so I'm seeing a lot of new retail kind of entering the space, wondering what to buy, but it's a very volatile market. You have to recognize some of the external risks in terms of macroeconomic conditions, as well as just expecting unrealistic returns. So yeah, expecting a big 5 or a big even 3 to 5x move on something that's just moved 5 to 7x, that's very unrealistic. Same thing with the SPY. Don't expect the SPY to really return kind of more than some more risky assets, but again, recognize that it's lower risk. So again, we just talk about risk reward with Bitcoin and that kind of thing. It's more volatile, so there's higher risk, but it can come with higher reward. That being said, if you aren't utilizing that strategy, it's really easy for emotion to get the better of you and then kind of bite you in the butt. You end up selling at a loss and just exiting, not looking back, and then you regret it later on and you end up FOMOing back in because you see the price has gone higher than where you sold it. So really don't expect unrealistic returns. Have a strategy. Be a little bit more on the conservative side. If everybody's if everybody's targeting 125K, it would be pretty poetic for the market to go just shy of that, really wrecking as many traders as possible and then dumping from there. So again, I talk about a margin of error in terms of buying into positions, and you really want to, if you're within a couple percent of your target entry, it doesn't hurt to at least kind of dip your toes. If it does reverse, then at least you've got some exposure and you're not getting caught up on those very, very specific price points. Again, we're not going to perfectly time top or bottom. If we do time top or bottom quite well due to technical analysis, then that's amazing. But what we want to do, again, we just want to position ourselves in these trends. We want to get in the trend at the bottom, and we want to exit the trend before it reverses to the downside, booking those profits and then moving on to the next investment. Again, so insufficient diversification, that's what I talk about over here. Again, you want to make sure that your assets are diversified. So if stocks are dumping, maybe your safe haven assets like gold, cash, that kind of thing, real estate, they might be doing quite well generally during times where volatile assets, so stocks, Bitcoin, crypto, when they're going down, your safe haven assets, bonds, cash, high interest savings accounts, that kind of thing, real estate, it's going to do a little bit better because that's the flight to safety. People are going to run there when they think it's a risk off environment. And then again, same thing when I talk about my individual portfolio here, I also structure it similarly as well, and you can do the same thing with stocks. So again, just make sure you're sufficiently diversified, but don't be so diversified that you can't keep track of everything. It doesn't really pay to own 100 different little penny stocks. Again, little stocks are a lot more volatile. You're better off sticking with a consistent approach to something like the SPY. But also, don't be afraid to kind of get into different little stocks like, Tesla, Nvidia, Google, Amazon. All these stocks are going to still be major players going forward in the future. So buying them at opportunistic times can be really beneficial as well. Don't worry too much. I kind of advise against penny stocks. I learned that as well kind of early on. It's what people said. That's where you're going to make money, but that's where the gambling is. It's a lot more volatile. I kind of prefer to stick to better known stocks with more price action, more history, a better kind of financial position most of the time, less volatile. So yeah, just make sure that you have that sufficient diversification. Make sure that you're not investing on a short-term focus. So really multi-year time frame is what you're looking at. A lot of people, you might be looking at investing over decades into your kind of retirement. So again, focus on the long term, not the short term. Short-term focus can result in frequent trading. Over trading is generally one of the things that will wreck people the most. Obviously, people do like to trade, and if you like to trade, that's great. You can definitely keep doing that. But again, separate your trading portfolio from your investment portfolio and treat them differently. Obviously, again, buying high, selling low, that's what we want to avoid. That's why we use technical analysis to recognize support and resistance. So we buy support and we sell resistance, removing the potential to buy high and sell low. We look at the impact of emotional decision making. So obviously, emotions significantly influence the investment decisions. Panic selling during market downturns driven by fear leads to realizing losses that could have been avoided if you were more disciplined. That's again what we talked about right here. If you panic sold down here, you didn't follow your strategy, you regretted it here. And if you panic sold here, you're just been regretting it ever since. So don't panic sell. Have actual conviction in the assets if you do believe in them. And again, follow that strategy, remove the emotion. And so there's also challenges in timing the market. A lot of people think you need to perfectly time top or bottom. I've just kind of shown you through the different DCA strategies. You don't even have to buy into the market all at once. You can just average in over a long period of time, and then if you want, really take advantage of those substantial dips. Time in the market generally does beat timing the market. So someone who you're better off or more likely to have success in the long term just by being in the market for a substantial amount of time there. So yeah, just pay attention to that. We see obviously challenges, time in the market, influence of the herd mentality. So I talked about this. Following the herd can lead to investment bubbles. So obviously, Bitcoin's one that goes through these crazy cycles. These are mania phases here, and then these are bear markets here. So it's obvious what you want to do. You want to be buying down here, and you want to be selling up here. And you want to be buying down here, and you want to be selling up here, because that's resistance and this is support. We don't buy high and sell low. So just keep in mind again that we just want to we don't want to follow the crowd, because you might be following the herd to the slaughter. Definitely, again, we just come up with our own strategy, and it's just based on data, it's based on charts, and then again, we're not listening to someone else doing what they tell us to do. Really believe in your own investments. Obviously, investors buy into overvalued assets during hype phases. We did see that last cycle. Lots of people coming into Bitcoin after this big move, buying up here, selling down here, buying up here, selling down here, cutting their losses, wishing they never got involved in the market, when if they just adopted a bit of a more data-centric approach to the markets, they would have been able to recognize these times of peak euphoria as well as kind of peak despair down here, these long extended bear markets, and then you understand this is the time to buy here, not up here. And again, just removing that chance of buying up here and having to ride that all the way down. Moving on, obviously, we saw that in the dot-com bubble especially, as well as the great financial crisis. Another last thing I want to talk about is confirmation bias. So confirmation bias is essentially a common mistake retail investors make. They essentially only listen to the opinions or data that supports their current investment thesis. So if someone's bullish, or let's say someone's heavily exposed to Bitcoin right now, they don't have any cash, they're going to be looking for someone that's going to kind of confirm that bias in their mind. They're looking for someone who's going to tell them the markets are going to keep going up. They're not looking at the data. They're not looking how this has come into resistance. They just want to hear that their investments are going to keep going up. They're unwilling to kind of acknowledge the potential downsides. And that's, again, what we call confirmation bias. So make sure you don't have any confirmation bias. Again, we just focus on the charts, and that's what removes all of this. So by having a data-centric approach to the markets, we really do kind of remove that potential to buy high and sell low. We're being patient. So yeah, again, you're just going to wait, up here. If we look here, we're patient. So we see up here, we've taken profits rather than investing back into the market right away. We're just patient. Wait for the price action to support your thesis again, and then that's when you get in. So again, yeah, basically, you don't want to over risk. You want to be really patient. You want to come up with a strategy, and you really want to manage your emotion. Those are going to be the biggest things that really kind of allow you to be successful in these markets over long term. If you're being emotional, it's going to bite you kind of in the long run. And again, if you're taking on too much risk in the event of a broad market breakdown, that's going to be really tough. If you're majority into Bitcoin, let's say you have 90% of your net worth into Bitcoin, and we go through one of those 60-70% bear market drops, like you're going to have to sit there and watch your net worth go down 70%. And that's kind of why every risk tolerance is different. So really weight kind of the assets that you believe in. You believe are lower risk, higher. So again, things like the SPY index funds, that kind of thing. And again, just come up with a strategy. I'm going to be here to help you kind of develop these strategies, show you the way I look at things. So I've shown you kind of how to dollar cost average into positions. I've shown you how I structure portfolios, and I also will continuously show you how I approach the charts, what I look at for technical support and resistance, as well as how I'm going to continue trading this market going forward and investing. And you're welcome to follow along. If we can do this together, we can continue building a knowledgeable community of self-taught investors. And again, I really argue that this is such an important skill for young people to learn. So if we think about it, I did the math yesterday. So essentially, I looked up the average time that a person spends scrolling on their phones during the day, and it comes to about 4.5 hours per day. And when you look at that on the scheme of your entire life at an average life expectancy of 79 years, that's 15% of your life, or 15 years of your life. So 14.75 years of your life, or about 19% of your life, is literally spent scrolling on your phone, and the majority of that is probably spent scrolling on social media. So the last thing I want to leave you with is kind of really focus on valuing your time and your money. So when it comes to investing, you're not gambling your money. Make sure you have a thesis, you have a strategy, and you're investing in things you believe in over the long period of time, because you need to kind of have that strategy. Otherwise, you're just risking that money. And then again, value your time. So you might think, I don't have time to learn all these things. I don't have time to invest myself. But think about it. If you're spending 4 or 5.5 hours on your phone, think about, maybe you can spend a little bit less time on Facebook, maybe a little bit less time on YouTube. Dedicate, maybe it's 15 minutes, maybe it's a half hour, as much time as you can really afford to kind of start to learn these tools as well as practice them yourself. It's going to give you that advantage in the long run. So again, I started valuing my time and my money. When it comes to things I want to buy, I really think, do I actually need that, or is it just something I want? And again, I put that money aside, and I'm going to use that to invest, because I don't necessarily necessarily need the frivolous toys and the fancy things in the immediate short term. What I'm building for is the future, the financial freedom that we all want. None of us want to be stuck in a 9 to 5 our entire lives. So again, practicing that discipline throughout various aspects of your life is going to help translate back into your own investment thesis and benefit you in the long run. So yeah, really just keep that in mind. I know it's been a little bit of a longer video, but these are, there's so many things that affect the psychology of the retail investor. I've been through all of this myself multiple times. I had to learn from my own mistakes. It took years and years, essentially, where you really start to nail down where you've gone wrong, come up with that strategy, and now I'm at the point where I figured out a strategy that works for me. It's removed all the emotion. My investing has become infinitely more successful than it was initially when I was kind of just going in blind, and then that's what I want to teach you guys. So again, we can just compound nice returns over a long period of time and really set ourselves for success in the future. So thanks for listening, guys. If you learned something new, if you like the content, please like, share, subscribe, and I'll see you guys in the next one.